everybody. Thank you for being here this evening. My name is Natasha Phipps, and I know I got a lot of messages saying I'm watching the game, send me the recording. So I do know there is multiple sporting events, but one main one tonight that we're all very excited about. So I'm going to keep that in mind. And if you are watching the recording, no problem. And if you have any questions about anything you see on the recording, please reach out and let me know. But we're going to jump right into it here this evening. So I wanted to host a webinar focused on realtors. So if you don't know who I am, my name is Natasha Phipps. I am the CEO and co-founder of WealthShare REIT. But first and foremost in real estate, I was a real estate investor first. And I've had a passion for real estate. As long as I can remember, since I was about 20 years old. I'm 43 now, and I have been a realtor for almost 18 years now. And the real estate investment space has been my niche since beginning. And I have also worked with a lot of realtors through my career. And bringing this all together is part of what WealthShare is all about. But one fundamental thing I know about realtors, and I've been through it as well, is how challenging our career is in terms of the ups and downs. And there is certainly that roller coaster that we all can feel in our career. No matter how good of a job we do, there is still always this, little bit of up and down. And there is also a challenge when we have unexpected events in life. So, sicknesses, things happen in life. And being self-employed, we don't have, sorry, I need to get my glasses, we don't have a lot of security blanket. And so one thing I have found is a few ways to use real estate to build a bit of a security blanket for myself and my family. I do have two kids. I've been married for 16 years, and they are a big part of my drive for trying to create as much security as possible while still pursuing a career that I enjoy. So that has kind of been the background of kind of how I got here. WellShare was started about 3 years ago, and we're a private REIT here in Calgary, and we allow a passive way to invest in real estate, which we are going to talk about as well. But first, I want to talk to you about real estate investing in general, how and why it's so lucrative, and also why I think realtors in particular they certainly have an edge above other consumers when it comes to the real estate space, and I think can use their knowledge in several different ways to help build a bit more of a security for ourselves and our futures and our families. So I think the real estate investing, space, I think a lot of consumers believe realtors are educated in this space, and it really takes you going out and educating yourself. So a couple things I want to highlight tonight is number one is why real estate and how to actually use real estate. And I'm going to show you also numbers and how returns are calculated on real estate as well. This will directly help you in your day-to-day job if you do work with investors at all. Let's talk about real estate for a few minutes. So real estate is one of the only vehicles that allows you to leverage someone else's money, the bank's money, to invest that money into something that will benefit you in the future. Higher net worth people may have other options for that, but the average consumer is not going to be able to take on debt to invest in anything else other than real estate. And so that is a huge thing to kind of wrap our minds around about why real estate. And then also the long-term compounding effects of real estate are quite exciting when you start looking at 5, 10, 15, 20 years of home ownership, whether it's your primary home or a rental home. But the reality is in this country, the rates of home ownership are just going down, and it's just getting more hard for people, for realtors, for everyone to own their own home, never mind owning rental properties. And so the leverage is a big thing. And usually when people are brand new to real estate, they focus solely on, well, why would I want to go, take on $500,000 of debt to have $150 a month cash flow? Like, Natasha, that makes no sense. And that's true. Why would you want to do that just for that? And what we're missing when we think about that is we're missing the most important and predictable part about the real estate investment, and it's not the cash flow. The cash flow is important. You don't want to be negative and underwater all the time. But what is the most fundamental part of real estate investing is the debt and mortgage pay down, building that equity for you. That is something that your tenant, your customer will do for you over time. And that is really the kind of why behind real estate, and also why you need to give it a long term in the market, because you need to see that debt paid down. And so I'm going to pull up here a Phipps Real Estate Group branded cash flow sheet. So if you don't know, I'm also the team leader and, well, co-team leader with my partner Andrea of the Phipps Real Estate Group. We're an investment specialized real estate team here in Calgary. And I'm going to actually show you a pro forma that we use and break down kind of the ways you make returns in real estate, because I think that's really fundamental to understand as a realtor, but also just as a real estate investor. So if you can't see my screen, please let me know and stop me. But I'm going to try to zoom into this here a little bit here. But this is actually an example of a property I'm looking at right now for a client. This is actually in the upcoming TAZA. And this sheet is going to give us a quick snapshot of what each month would look like in terms of cash flow, but then also on an annual basis, what our return on investment would be. Our ROI means return on investment. When we're talking about single family real estate, something with 4 doors or under, these are the metrics I focus on. Cap rates do tend to get thrown around a lot in this space, and really should only be an indicator on the commercial multifamily side. They are really not to be used in the residential space, and I'll explain why when we get to the commercial side of things. So thinking about residential, this is an example of a property. This is a semi-detached villa style property. If you haven't seen these yet, they're very cool in Taza, but this property has a legal suite in it. It's going to be a potential rental for this client. And so we went through to look at what could this property look like. So when you're figuring out your ROI or your cash flow, you need a few fundamental things, which are pretty basic. And there's many calculators out there that you can find, spreadsheets, all kinds of things. But the main things you want to figure out is obviously what are you going to pay for the place? And the first one, which is where we can get stuck, is rental income. And what is the rental income going to be, but also what is it going to include? So when we think about rental income and how to find data, the best way I know how in Alberta and especially Calgary is through Rent Faster. You can get a free landlord profile on Rent Faster and be able to see a few different tools than you can when you're just searching around. So I highly recommend that for every realtor to be using that source when they're working with investors, to be able to try to find market data on what is actually happening in the market. So in this case, this is a really unique property. It's actually hard to guess this rent, because there's nothing like it really in Calgary. There's very few things that would be comparable to this. So we took quite a conservative approach. The builder's numbers actually came in significantly higher of what they were projecting. But what we projected here was 2,500 for the upper and 1,550 for the lower in this example. And if there is questions, by the way, jump in and let me know. We're going to fill in, of course, all of the expenses. This should be pretty straightforward. In this scenario, they were going to be managing themselves, so there was no property management fees, but you would want to put a fee here. And you will notice in this example, if we have to put a property management fee, we would actually be negative cash flow. But in this scenario, I just figured I would share this because I was working on it recently. We would put in all of our expenses. That's going to shoot out our total expenses here. And we have our net operating income here. Now, your monthly debt service, this is where we start talking about leveraging the bank's money. This is where we want to think about how we're going to finance this property. So in this example here, this individual was going to put 20% down because this was a rental property. So need to put minimum 20% down or more. You can put more. And this property is projected out quite a ways. And so we thought maybe a 4% interest rate when this is completed in about 18 months or so, depending on the lot they chose, but we would play around with this. And oftentimes when I'm working with clients, we'll use a higher rate and a lower rate and play around with it to look at best and worst case scenarios. So you really want to play around with this. So in this example, what I wanted to show you, if we end up getting an interest rate of 5%, next thing you know, on this opportunity, their cash flow is negative $300 a month. And so that's something that they want to be mindful of. Now, again, I think I'm being conservative on rents, given this is a villa style property, but still good to be conservative. And so we play around with these numbers with our clients, and you can find tools out there to do this as well. I do always recommend, one thing I notice new investors often don't know or forget to input is their amortization. So on residential income properties, you can amortize up to 30 years. So that is an important difference when we're trying to, increase our cash flow during that period of time. And then, flip the coin. People go, well, Natasha, I want to also pay down my debt as soon as possible. I do still think amortizing over 30 years and giving the opportunity to offer lump sum payments once a year. If you have extra cash, do that. Great. But also plan for those rainy days, and you want to lower that mortgage payment as much as possible. So this is the mortgage information. Now, in some cases, a client of yours might be getting the down payment from a line of credit. And so that's why there's a second line here, or there could be a second mortgage. But in that case, of course, that would, if there was a cost to the down payment, you'd want to outline that here. And that would make it even more challenging, especially on this example to cash flow. And I can show you other examples as well. But so in this one, the things we're inputting are the price, the income, the expenses, and then also the appreciation here. So you can play around with this number as well. In this example, we put a 3% appreciation, but even if you put, 0% appreciation, what does that look like? Or there's a 2% appreciation, what does that look like? So you want to be playing around with these numbers, and you also want to be realistic. So 3%, if you're looking at over a course of a 10-year period or something, is pretty reasonable for Calgary. And what this is going to do is, let's put this down maybe to 4.5%. What this is going to do, and what we want to highlight, is this return streams here. So this is our ROI. This is the one thing I want you to take away is there are 4 ways to make returns when it comes to real estate in the residential space. One is cash flow, and this is usually what all people think of. And to be quite honest with you, to retire off of cash flow, or to be able to have a rental portfolio so large that you're just going to live off the cash flow is, to be quite honest with you, very, very challenging, because there's always things that come up, right? And costs and expenses, even if you calculate and are conservative as possible, it is challenging. But the real reason, in my opinion, why the real estate investing space is so lucrative is these 3 items here. So principal recapture, or your debt pay down, is one of the most predictable things you can possibly think of. You're able to get a schedule of what your mortgage will look like over time. You'll know exactly what your balance will be in 5 years, and you'll be able to have a very good idea of what those returns look like. And this is the reason, really, what makes real estate so interesting. Passive appreciation. Now, passive appreciation gets used a lot in, like, when people are thinking short term and they're thinking about flipping a property or doing, condo assignments or things like that. And really, when we're to be conservative and realistic in real estate, thinking long term is what we should be doing. So passive appreciation is no different. But if you look at any snapshot of, Calgary real estate or Alberta real estate for a 10, 15, 20-year period, there's generally, you're going to see a pretty consistent growth pattern in our province and in our country. And so this is another fundamental reason why people like investing in real estate. And then this last one here, active appreciation. So what this means is, let's say this property doesn't need it, but let's say I was gonna put a garage on this property, or I was gonna add a basement suite, or I was gonna do something in it to improve it. So let's just say I was gonna spend $20,000 on some type of improvement here after I close on this property. But I know as a realtor, and you know as a realtor, and this is where the expertise really starts coming in, that a garage or a basement suite or whatever it is, it could be a kitchen, it could be anything, will definitely improve the value of this property more than $20,000. Let's say it improves it by $40,000. That now takes into account this investment that we made of $20,000. This formula takes into account that $20,000 improvement of our valuation. So now all of a sudden you can see in year one, by adding very conservative cash flow up, conservative appreciation and debt pay down, and a little bit of improvements, whatever that might be, getting a good ROI as high as this is becomes quite achievable in the first year. But even without that, even without any active components or doing any work, generally speaking, what I say is when you're doing research like this on a property or an investment, whether it's a short-term rental, long-term rental, whatever, if you are actively buying the real estate and you're actively putting in the work and the money and the time, this year one total ROI should at minimum be 20%. This one is a little bit tight, and it's a little bit tight. And the reason these people are looking at this one is because they want to live in it in a few years. But so they're not as concerned about being the best, cash flow performing rental property. They just want to make sure it's going to take care of itself for the first few years. So in this case for them, this might make sense. We have other properties that are certainly going to cash flow a little more. They're going to be a cheaper price tag. Like you can get a suited property in the low 600s that's legal and does its thing really well. So this is the kind of active cash flow ROI calculator. Does anyone have any questions about any of this? Okay, so I'm going to stop sharing that. And then what I want to compare to is on the multifamily side of things, and how the ROI calculation does differ. And then we'll talk a little bit about the passive investing side. So if you're a realtor, obviously you're probably have heard a lot about the MLI Select program in recent years. You've heard of a lot of investors turning from the residential space into the commercial multifamily space. And I want to tell you a few like fundamental reasons why that's happening, and some things that, like, if you're not licensed in that space, you might not really be aware of. So number one, and why the multifamily space becomes interesting, is investors often will run into a wall in terms of residential lending. They will kind of have maxed out how many mortgages they can get, perhaps, but still want to grow. Or they are not in their highest earning years. They are maybe semi-retired and they're not showing a lot of income. And so it makes it challenging to get approved. And so people turn to the commercial lending world, where they will lend to you based off of what the asset's performance is in combination with your net worth. One huge thing that I see out in the space, that is a huge myth, is that you don't qualify for the property, only the building does. And that is not exactly true. They definitely still want to know that you are capable of being successful at running your business, that you have good credit, and they want to see good solid net worth, and they care significantly about your net worth related to your borrowing power. So they want to see a minimum of 25% net worth of whatever amount you want to borrow. So if I want a $10 million mortgage, at minimum, I need to prove I have a $2.5 million net worth or more. And it may be more if they feel you are a riskier client. But what is the fundamental difference? As a realtor, if you're in the residential space, you know that, like, my house that I'm sitting in right now, my property's value is very much determined by what the market around me is doing. And so the sales on the street impact my property value, along with what's inside my property, of course. But the big fundamental difference that's different in the multifamily game, when you start getting into the commercial lending world and the multifamily appraisal space, is the valuation of the asset is not a result of what so-and-so across the street sold their property for. It is a result of what the operations of the property are doing in terms of my net operating income. So what I love about that is really the tighter of a ship you run, the more efficient you are, the better you manage it. There is a huge difference on what your property could be valued based on how well of a job that you do taking care of it, managing it, keeping good care of your tenants, staying up to date on maintenance. All of those things really do show when you want to go get an appraisal. And so those two things usually start interesting people on the multifamily space from a lending environment, but also just from a performance environment and how these properties do. And I wanted to pull up here to show you how the kind of space works a little bit with an example of an underwriting. Now, this is going to be a little bit hard to see, but I'm going to do my best to explain it here. And if you ever want to reach out for this file, I'm happy to share it with you one-on-one. But so in the multifamily space, when you go to look at a property, you get the basic information of like the rent roll, what it's going to rent for, the expenses, and all that kind of thing. Then you go to your broker and you say, okay, this is information similar to what we just had on the residential side where we have the rental income and the expenses. However, this is where the big difference comes in, is the two things that are really important is how we're going to value it and what the lender will see. So in this example, I'm going to try to zoom in a little more here. This is it's a simple row type of property. It's only a 5-plex. I'm just using this as an example. This property this was over a year ago that this was done, but I just use it as an example because I have it. This is like townhomes, and there was 5 of them in here. Now, in this case, the appraiser on this property estimated the rental income for each unit. These are pretty large units to be about 2780 with the main house, and then adding some parking and some pet fees in addition. So the appraiser gave me this information. This was not my opinion. Now, so they gave me this gross revenue estimate here. And then what becomes very important as we go down here, when we start thinking about vacancy rates and expenses. So in the world of this commercial space, we just mentioned how my net operating income is what's important to valuing this property. So if I want the max valuation, then I want to show the best net operating income. The reason for that is my mortgage amount is going to be a result of the valuation, right? So in this example, we have our income. Now let's talk about vacancy rates. So in this example, in this area, this was zone Calgary Northwest. In this example, they're using a 3% vacancy rate. So what that vacancy rate comes out of our income and actually will lower our loan amount. The higher the number we use here will mean I'll be getting less in terms of the mortgage that I'd like to get. So that is why how CMHC looks at vacancy or other expenses, as you'll see down here, does really impact you, even if the actuals are different. So to keep this as simple as possible here, these are the other operating expenses. If we're using a CMHC insured mortgage product on the multifamily side, which has become so popular in recent years with the MLI Select program, the expenses here are, so we have insurance and taxes here. Those are projected. The maintenance and repair, the salaries and the management and the other costs, all those numbers are actually determined by CMHC. So they will decide what number goes here. So even though I'm not going to have any salaries, I'm not going to have a salaried employee, we still need to account for it. And all of these expenses will, of course, reduce our net operating income and further reduce our loan amount. However, that is all interesting for a lot of people because of the reasons that we spoke about. So I want to talk about cap rate here for a second. People get into the multifamily space and go, what's the cap rate? That's the first thing they ask. And we always like to kind of have a little bit of a chuckle around that because it's one indicator on many things to be considering. And it's also influenceable a little bit. So your net operating income like right here, residential net operating income after everything we just went through, came out to 142,935. So in this example, we're going to use a cap rate of 5%, or not we, that's what they used. And that is what gives me my value of 2.9 million here. So as you can see here, they put here cap rate low, 4.5%, cap rate high, 5%. So if you change these numbers and, even work with your appraiser, that would change my valuation, which would then, of course, change my loan amount. So the biggest difference in this space is all of these numbers are kind of very fluid and they move around a lot and they highly change your result in terms of what your borrowing power might be. So in this example, what I was trying to figure out was to make sure that the asking price of $2.9 million was reasonable given the current rental market. And in this case, all of the underwriters' analysis came up with a valuation of 2.828. Sorry, 2.828 was what the builder was asking. So that came in, reasonable. If there was a huge difference in these numbers, that we would have an issue. And I won't be able to go into huge detail. I'm going to try to show you real briefly the difference here when you're underwriting these things on the multifamily side. Have you guys heard of the MLI Select program? Have you been paying attention to how many investors are posting about this? If you remember nothing else from this tonight, the single most misleading thing out there in the marketplace from realtors, consumers, investors that I see is when it comes to this space is realtors marketing, say 5% down payment with the MLI Select program. And what's really important to understand is the loan to value ratios that we see on the residential side is fixed, right? Like you need to put minimum 20% down and you sign your mortgage documents, you remove conditions, and then we wait for closing. That process could not be more different on the commercial side of things. You actually don't even know your mortgage, like your interest rate until closing time. And it's dependent upon the bond market if you are using a CMHC insured mortgage. So that alone will change everything as we just saw, right? So what I want to point out in this example is as related to the MLI Select program, your loan to value does not mean loan to purchase price. CMHC, their job is going to be to reduce risk and to reduce, volatility. And so all of those indicators that we just chatted about that they can change, they're going to try to reduce risk and to reduce their exposure. And so very rarely, I think I have only seen a couple of instances, honestly, where it comes out to a 5% down payment. That doesn't mean that they're not getting 95% loan to value, but value does not equal purchase price. Those are two very different things. And so that is one really important thing. And where people are honestly getting themselves into trouble because they'll say, well, I have 5% of this building. And so then they start down this path and they waste a bunch of money on appraisals and environmental reports and things. And then don't understand that they actually, need maybe 15%. So very different world. This chart I could talk about for an hour, but the one thing I wanted to point out was on the CMHC MLI Select program. This is a program in the multifamily space meant to improve affordability, accessibility, and efficiency when it comes to multifamily housing in Canada. And it's really one of those things that the more you give CMHC, the more they'll kind of make it worth your while, so to speak. They are also, though, the only game in town. There is no other option to work with in the multifamily space, whereas in residential there is for insured mortgages. So whatever they say is what goes. That's just how it goes, and they change policy quite frequently. So what I wanted to point out here was this little fiveplex that we talked about. What I want to show you, I'm just going to zoom in here. Remember we talked about the more you give them, the more they will help you. So in this example here, there's a column for affordability, energy efficiency. If you were using accessibility, that would also be here. But basically what this means is if you cooperate with CMHC and make your units affordable, and affordable relates to the consumer price index in each city. So it does vary. But if you do that, they're going to change we'll slide over here. They're going to change your debt coverage ratio. They're going to change what the premium is that they're going to charge you. And also the equity requirement will change. So what I wanted to highlight here in this multifamily space is all of those variables we talked about in combination with all the MLI select features. Look at how much this equity requirement changes. And like I think the lowest equity requirement for this was 173,000, upwards of over $500,000. So this is why it's not black and white. It's not cut and dry in this multifamily space. It is a very different world and a very different financing game. And really the entire space is very much a financing strategy. So very different. I highly recommend anyone jumping from the residential space to the multifamily space to make sure you get educated and you're working with a team of realtors and mortgage brokers and everyone who do this side of the business a lot. I have some tales I could tell of what we have been through. We have acquired and refinanced several times now and have learned a lot through the process as WealthShare. And that also helps me a great deal as a realtor, helping clients through this, having gone through it myself. So I'm going to stop sharing that there. I know it's a lot to kind of go through. Yes, it is. The program is like lucrative, but it's also very complex. And in some cases, it doesn't make sense, to be quite honest with you guys. But I wanted to really point out the differences, how we make our calculations vary a great deal. So that simple sheet.
I can definitely second what you say. Experience matters. Getting through CMHC, even
Oh,
within
yes.
CMHC, if you're working with someone who's already got experience,
Yeah,
then they have a track record within there, and that will make the difference. Yeah.
absolutely. It makes a huge difference. There's like anything, you want to work with people who are doing that day in and day out, right? Like you're going to get a very different experience. So I'm going to switch gears a tiny bit and talk a little bit about WellShare. Before I do that, though, the we talked about how ROI is calculated on the residential side. So as you can imagine, calculating your return on investment on the multifamily commercial side of things is super reliant on how you finance it, what the rental market is going to do, how you manage your expenses, who is going to manage it for you, and there's just a whole host of other variables. So that is why the multifamily side of things is more advanced. It is more challenging. It really requires a team to handle it all. And what you would want to do if you were wanting to calculate your ROI on the multifamily side of things is you would want to get your mortgage broker to actually provide several different options for underwriting the deal. So there's different types of financing products out there. There's different levels of the MLI Select program. I highly suggest the MLI market route in a lot of cases right now, rather than the full MLI Select program for many reasons. But if anyone ever has questions about that program or want to reach out, please let me know. I'm happy to kind of connect with you. But you would need to take that underwriting and then you would need to apply that into something like we had for the single family property, but much more robust, right? But the main thing is you cannot calculate the ROI without the underwriting part done on the financing. And then you can still have similar return like lines. You'll still have your debt pay down and your cash flow and some passive appreciation of your income. And you can also have what's really interesting for older properties is you'll also have that active component. So if you have a client who is interested in multifamily and they're handy and they want to do a project, and the really cool thing in Alberta is that our landlord laws are definitely more favorable to improve a property. So you can, turn over units, improve them, and get them back out on the rental market within, a year or two, whereas in some provinces that could take decades. So lots of opportunities on the multifamily space here in Alberta. And something that we love here at WealthShare as well. So I'm gonna just put on another slide here and tell you a little bit about WealthShare and what we're doing. So as mentioned, I am a realtor by trade. That is what I've done for the last 18 years. And we do residential, commercial, and property management here in Calgary with the Phipps Real Estate Group. 3 years ago, I co-founded WealthShare with my partners, Rodney Phipps and Monique Verlon, and we have something that we're pretty proud of a few years into this. Just as a FYI, this is our disclaimer. It is on our website, wealthshare.ca as well. All this is saying is what we're going to talk about here is for educational purposes only. Any projections are just that, projections, and nothing is guaranteed. And this is not a solicitation for your investment. So we talked about the active side of things, and I fundamentally believe that every realtor should own real estate. I am super passionate about that. I think there's many ways you can own real estate. You can own your own home. You can joint venture. As realtors, you are in the best position to know when there's good opportunities, and there is joint venture opportunities out there for you if you get really into this investment space. And I have done many joint ventures myself. They have, set me up for success in many, many different ways. And don't ever assume what other people, have or what they want or why they might want to partner. So that's what I believe on the active side. But I also really believe in the passive side of investing because, like all things, we can't be experts at everything, and I can't be actively involved in everything, but I can passively invest in different things to diversify my investments and what I'm exposed to in the market. So, what WealthShare is we're a private REIT located here in Calgary. And our mission is to provide a way to passively invest in multifamily assets, and we target a 12% annualized return. We value a few things: transparency, accessibility, and education. Education, what we're doing here this evening, is a big part of it. And we do a lot of sharing along the way. We bring in guest speakers, we bring in a lot of different speakers and topics to round out our financial literacy and education for our network. We'll talk more about how we get our transparency and accessibility here in a moment here. This is our team. Something that's interesting too about us is it's not just me behind this. We have a whole team here. As I mentioned, my co-founders, Rodney and Monique. We also have Michael DiPaolo, our investor relations head, who is here this evening, I believe, Michael.
Hello, everyone.
Oh, he is here.
Pleasure.
Thank you. But we also have a board of trustees. So when there's any major decisions that occur, it isn't just me making a decision and we're going with it, or Monique or whoever. We all have a vote. There is 6 of us right now as trustees, and we each have a vote. So who these people are and who's making decisions, whether you're investing in WealthShare or any other passive opportunity, is really important. Is who are the people? And I can also tell you that there are some groups out there where there is only one trustee and one founder and one person making all decisions. So just because we have it set up this way does not mean that everyone does. But what I want to do is kind of run through what WealthShare is doing, but use that as an example and a way to analyze other passive investments in the marketplace. Of course, we love what we're doing here at WealthShare and would love you to be a part of it. But more importantly, I want you to learn how to look at these things and the things that I think you should be asking about and comparing when you're looking at different passive investments out there. So what is a REIT? And if you start looking, there's so many different funds and REITs out there. But the vehicle and what a REIT is it's just a passive vehicle to pool capital together and use it towards a common goal. There is, you can invest in storage funds and seniors housing and all kinds of different things. But the vehicle, that's kind of the idea of the vehicle. the accountability and compliance is a big part of this. And so I want to take a moment to talk about this. This is, if you're looking at passive side of things, this is the most important thing to learn if you're new to the space. In Canada, there is levels of regulation depending on the type of passive opportunity that we are talking about. Now, we are registered with the Canadian Securities Administration. We are governed by securities laws in each province. We follow the Ontario Securities Commission laws for WealthShare, and that comes with a few things that benefit investors. So number one is on this side, when we talked about our kind of goal of transparency, this is an important one, is annually, we do an annual financial audit. This is an independent audit. This is not us doing an audit internally. We outsource and pay a third party to audit all of our operations as it relates to you and your returns and where your money is going and how the returns are made. At the end of that year, we are provided an audited set of financials, which you get access to, that also really result in how well did we perform that year before. So that's a big one. That is different than if, say, we're going to joint venture, the two of us, let's say, that's not a step we would be taking, most likely. You could, but it would be quite costly. And so that is a benefit that you start to receive when you start going into these larger structures. The middle one here, on the passive side of investing, this is the most important. I should just have a slide just for this. On the passive side of investing, the government of Canada has there's three, but the accredited and eligible investors is the average Canadian. Now, what does that mean? Those terms really determine what is suitable for an individual to invest in something like WealthShare or other funds like us. And it's not something that, in my opinion, enough of our competitors talk about. I don't think they educate enough on it. I don't think consumers know to ask about it. But we believe this should be at the forefront of your conversations on the passive side. And often, looking at anything that you see kind of that goes sideways out there in the marketplace, this was not being paid attention to. And really what it means is the status, it's not like something you go get approved for. It's based on your net worth and your income. It could be you as an individual or you with your spouse. And really that determines what might be a suitable amount to invest in something or to risk in something. Generally, what you'll find, the higher the promised or targeted returns, hopefully they are targeted, the higher the risk, right? To make higher returns, you need to take more risk. And that might not be suitable for someone doing their very first investment with only X amount of dollars available. So if you do not know which classification you are in, you can Google the definition in terms of your income, your financial assets, and it'll tell you. You don't need to prove it to us necessarily. It's more just, but you need to answer the questions as to which one you are. And what you'll find is only REITs or funds that have what's called an offering memorandum are technically able to accept investment from eligible investors. And that is why, if you are not being asked about this, that is a bit of a red flag if you're out there in the marketplace and they're not asking you about your status. So that's why I'm spending so much time on this. I don't want to promote that at all. I think this should be front and center in every conversation you're having on the passive side out in the world. Okay. So what are the benefits to the investor? The first one here, tax efficiencies. So you can use your registered funds to invest in something like WealthShare, which is pretty cool. You can speak to your accountant about this and how to align your tax strategies with your investments. But you can invest your tax-free savings account, your RRSP, your RESP, your LIRA, and that combined with your retirement plan is really, really powerful. So that's a big one. A lot of people do not know that they can take their registered accounts and self-direct it and invest it in what they want to. And you also do not want to take all of it. You can take a sliver of your investment funds, which I would recommend, and investing in different things that you are interested in. Given you are in real estate, I would imagine you're interested in real estate. So this is something a lot of folks don't know. The next three things are ways to diversify your portfolio, be invested into things that you don't have the knowledge about, like, for example, the industrial space. I, at this point in my career, maybe one point I will, do not have a lot of experience in the industrial side of things. So, looking at passive ways to get into that sector is something that I have been considering. So, looking at different asset types, strategies, locations, things that you're not able to do on your own to be more diverse in the entire real estate game is really, really critical, in my opinion, to reducing your overall risk in the long term. Also, be able to access larger opportunities. Like for us as individuals to go buy a building is challenging, but we can do that as a group. So we talked about multifamily already, that we kind of why we like it. But one thing we didn't mention is the investment into hard assets. Being able to see, feel, and touch something is very different than investing in the stock market, which is very emotional and volatile. So hard assets really become important, especially to higher net worth individuals later on when they're trying to protect their hard-earned money that they have made in their lifetimes as well. So those two things make hard assets and multifamily real estate very interesting. And they're also predictable, especially when we're talking about this buy and hold strategy of just, buying property and renting it out and managing it. That's a pretty predictable strategy, which is nice. We already talked about the financing and valuation, but you also start to get economies of scale as well. So like we talked about earlier, where do the returns come from? We already kind of talked about all of these things. We didn't talk too much about value add, but we did touch on it a little bit. The value add component adds up very quickly, and it doesn't necessarily need to mean a huge renovation either. It can just be even being, adding a dishwasher, and you can add a little bit more rent, or allowing pets, or whatever it might be. It's those small tweaks add up quick in the valuation side of things. So that's where the value add comes in. So the housing story, I mean, we're all very familiar. I won't spend too long on this, but obviously being able to invest in the housing sector here in Canada has been a big topic here in Alberta. Being here in Alberta, you're very probably much aware of our population increases, our economic, diversification that we are seeing, and it is attracting a lot of Canadians. And the reality is Alberta is still affordable in comparison, and so we are attracting a lot of people who want to live here in our backyard. So many of you know this. I will not spend too much time on this aside from one of these about why investing in Alberta. Pro business, being a diversified economy, our growth when it comes to many sectors of the market. But the last one here too, in talking about multifamily real estate, is probably the most important one when we're comparing against different provinces. The rental tenancy legislation here in Alberta is a lot more fair. Number one is we have fixed term leases that mean exactly what they say as fixed term. It's much more easy if you have a problem tenant or a challenging tenant to come to a resolution. We have much shorter wait times, and we don't have rent control either. So those are all things that make investing in Alberta appealing. So what we are doing here at WealthShare is pretty simple. We're not reinventing the wheels. We're buying good long-term buy and hold assets here in Alberta. We're also looking at Saskatchewan, and just trying to do a very good job managing them and just long-term buy and hold. We're not groundbreaking anything new here. We're really trying to thread the needle of good, steady returns, targeting that 12% while oh my God, kicked out, while focusing, in our backyard. So that is what we're doing. The first two acquisitions we bought were only a couple years old. They were both actually court-ordered sales. And the third one we bought was brand new in Edmonton, built by Mattamy Homes. But I want to take a quick moment to look at our offer summary and point out a couple of things if you're comparing us to others that I would be asking about and looking into. First thing that's not on this slide is who owns this real estate. And 100% of our assets are owned by our investors, which is surprising to a lot of people. I don't have a 20% chunk for myself or something. 100% of the assets are owned by the investors. So asking that question if you're out there. We talked about the first one on this slide, who is it open to, and what securities laws are required based on their offering. Can I use cash or registered funds? Obviously, we accept both. Is there a continuous raise or is there a target? For our fund, we're an open-ended fund, so we will grow, as time goes on. It's not like a case where we're reaching X amount of money and then we're done. That's not the case here. So it's an open fund. And no investment fees here. This is something, especially when you start looking at the returns you might be getting at your other major institutions, is how do we get paid? I'm going to talk about in a moment, but also what fees do you have as the investor? So there is no fees to invest with us. The only time there is a fee is if you use a registered fund. So if you have a TFSA or RSP, we do require to use a trust company as the intermediary. And so they charge a fee about $135 a year, I believe it is, 140. And they are there for very good reason, though, to ensure that we are in fact, a safe place to accept your registered funds. And they do all the kind of homework on us. And they also facilitate with the transaction of wherever the funds are coming. So you would have an annual fee with them. So you'd want to bear that in mind, but that is outside of us. The next point here is a really important one. We're looking at other ones, is how much do I need to invest? At the very beginning of this presentation, I talked about accessibility. I can tell you that when we went to our lawyers, when the three of us were at the beginning of this talking about what we wanted to do, and we said we wanted our minimum at around $5,000. At that time, that was not really, recommended. It wasn't suggested, but that was really important to us and really important to me as a realtor as well, because I know how hard it's becoming for people to own real estate. And so the intention here is we want people to dip a toe if they have to. We want them to get started. We want to make it as easy as possible to invest in something like this. And so our minimum investment is $5,000 or more. I also find that people have random amounts and random accounts, I like to say, when it comes to the registered side of things. So it doesn't matter for us if it's, 6,200, 12,100, does not matter. And then the next point is the returns. How are returns made, like we talked about? We target a 12% annualized return. That is our goal. And returns are made two ways. One is the equity component, just like on your home, or the cash distributions component. So when you invest in something like WealthShare or others, you will be issued your trust units, or you could kind of equate that to shares if you were like investing into a corporation or a stock, and you would be issued your trust units. And annually, when we do that appraisal and valuation and we do our full audit, there's a valuation done of the entire portfolio that results in the unit price, or the kind of like the share price. So our share price or unit price right now is $12.50. We started at $10 at the very beginning. So anyone who got in at the very beginning, they bought in at $10. If they were to exit or redeem today, which I'll talk about, they would redeem at the current price of $12.50. So that happens on an annual basis. So that's your equity component. Other component that can go into your returns is cash distributions. We did not really anticipate cash distributions in our first few years. It was a large cash undertaking to get this off the ground. But as time goes on and years to come, those cash distributions will definitely increase over time and would happen on an annual basis as well. We also have a DRIP program, so you could reinvest those should you want to. And most funds out there do, so that's something to ask about as well if they do offer a DRIP. And then an unlimited number of trust units. Because we are an open fund, that's why it's unlimited. So these are the assets I wanted to point out. I know we're getting to the top of the hour here, so I'm going to kind of try to wrap it up. But this is the type of things you're investing in. You can drive by these things. I can send you the address if you want to take a look at them. Drive by and see the types of things that we manage and the types of properties that we like. We're just buying good assets in good areas. And I've been a landlord in Calgary for over 20 years now. And so also taking that experience of what works when it's also not hot, right? Like we got to be mindful that there is shifting markets over time and we want to be thinking long term. So we have a property in Mission, Windsor Park, and Southwest Edmonton in Stillwater. We don't need to dive into that, but why investing with WealthShare? Again, these are a few obviously key points of what we offer. And how have we done? That's an important thing. The last 2 years of independent audited returns. So 2024, we did a 12.6% return, and 2023 was 11.1%, and we didn't quite have a full year. So we're really proud of these numbers. We are on track for a great 2025 here, and would love to have you join us. We have just under 300 investors in the WealthShare community and growing. So it's going to be very exciting as years go on here, that we have the ability to see this thing grow and be a steward of our investors' investment. So one last thing to point out is if you've never heard of the term exempt market dealer, what the heck does that mean? When you are investing in things like WealthShare, if they have an offering memorandum, which means they accept investment from eligible investors, then an exempt market dealer is required and mandatory to take your investment or to process your investment. So our exempt market dealer is Atlas One. They are a cool platform of all kinds of things on there that you can invest in passively, but we've been with them since day one. And they are licensed in these provinces to take investment in. And their job is to make sure that we are compliant, that we are doing what we say we're doing in terms of all of our appropriate paperwork and filings. And they are also there, most importantly, for you as the investor to ensure that you know what you're investing in, that you're assessing your risk properly, and they're going to ask you all those types of questions, so that you're not, speaking directly with someone like us and maybe not feeling as comfortable or taken care of. And they are also trained to look out for your best interests. So they're there for a very good reason. And we love working with them. So if you're interested in checking our offering out, Michael, you can put the link in the chat. If you're watching the recording, we will put it in the comments on the YouTube channel. But the process is pretty simple. Everything is done online. All the paperwork is done online. It's not a huge project. You can spend as much time as you want reading everything for sure. But in order to execute the actual investment, it is a pretty slick process that can be done in, under 20 minutes kind of thing. And that is just a summary. The last thing I'm going to point out, I know I'm 1 minute over right now, is if you were talking to other groups as well, what I want to point out and highlight is how we make a living here. I told you that we don't own the real estate. You guys own the real estate, or our investors do, and we invest as well. But the one thing to go out into the market is to ask that question: how do you, as the issuer, make money? And again, I don't think that's something that folks think to ask or think about. But what you'll see here is issuer fees, and that when you see that line on our offering, it makes it sound like that's a fee that's going to come off of your returns, and that's not the case. What that is a disclosure from the issuer, or us as WealthShare, saying this is how we are going to get paid for managing your money, and that is already taken into account when we are targeting our returns. So it's not an added fee or an added charge or anything like that. So these are our issuer fees. So when there is an acquisition, we get a fee. When there's a financing, we get a fee, and we get an annual management fee, of course. But what's really in it for us in the long run here relates to a cash distribution. So when we get to the point where WealthShare is doing our cash distributions, as long as we hit an 8% return to our investors, us as the management team do receive a 20% performance bonus. We're not there yet. This is a long-term vision for us for sure, but that's really what's in it for us in the long run. And then dealer fees just relate to what a group can pay for the exempt market dealer services or for other capital raising services. You have to put a cap on that. So that's what those two things are about. And of course, if you have any questions about that, please let us know. The only thing I didn't answer was redemption. And so, like, are you locked in for 10 years? Are you stuck, or how long am I invested? So how that works is you're not stuck in forever. You're not locked in for really any period of time. However, in the first 5 years, there is a redemption fee should you choose to exit. After 5 years, there is no redemption fee to exit. So things come up in life. We understand that. There is a 60-day window notice that you do need to give us of your redemption. And then we do our best to accommodate that as soon as possible. But any questions about redemptions or process, Michael can help you with that. And then the other place you can also go to learn more about us is we did just get a new website, and you can go to wealthshare.ca to learn more about us and our investment process as well, which I'll put in the chat. But that was the last thing I know I didn't mention. But yeah, Gavin, we would love to connect with you. And if you're watching the recording, please reach out at any time. We would love to learn more about your investment goals and answer any questions you may have. There is one more thing. If you are watching the recording of this, please know that WealthShare does offer a referral program. So as a team leader of realtors, one thing I know we are always working on is how to have multiple streams of income, how to have more tools in our tool belt. And so something like that could be a good thing you want to share with your clients. So if you want to learn more about the WealthShare referral program, please send us an email at info@wealthshare.ca. And we would be happy to tell you all about the program, how it works, and what we offer. Thank you.